Hey, it's Jim, and this is level 1 of the CFA program, the topic on equity, and the learning module on company analysis forecasting. I'm guessing that you don't even have to take a look at this learning module to understand what forecasting means. You can imagine that somewhere in this learning module, we're going to ask the question, how do we forecast revenues? How do we forecast income? How do we forecast assets? How do we forecast investment in positive net present value projects? And of course, that's all part of this learning module. However, this is a qualitative learning module. The Institute leaves the quantitative forecasting to other learning modules and instead essentially provides us with one learning outcome statement. Now, before I show you those learning outcome statements, I'm gonna divide this into two parts. The first part is, what kind of approaches do we take to forecasting? And then, what kind of data are we going to use in our forecasting models? So let's take a quick look at these LOSs. Look at that first one, explain the principles and approaches. All right, so that's what I was talking about, but there's revenues and expenses and capital investments and capital structure. And we're going to essentially take a look at 6 possible approaches to forecasting. And then we're going to ask what I think is a super cool question in this last LOS, regarding scenario analysis. And as you look at the learning module, there are pages and pages and pages of scenario analyses. So I'm guessing the Institute is not going to give you pages and pages of question stems, but understanding, describe the use of scenario analysis. This is going to be really important when we get to level 2 and we actually do a scenario analysis. So think of scenario analysis as an Excel spreadsheet with all of these accounts in them, revenues, expenses, working capital, all these things. And at the bottom, we have some number. Maybe that number is a net present value. Maybe that number is a free cash flow, or maybe it's a weighted average cost of capital. But with scenario analysis, what we're going to do is we're going to change some of those inputs and see what happens to the output. Maybe we'll change the scenarios. Maybe we'll go from an expanding economy to a contracting economy. And so you see the link between what we've done in quantitative methods and economic analysis, how they just seamlessly lead into a learning module on forecasting. All right, so you don't need me to tell you what that definition of forecasting is. We're going to use historical data, industry trends, management guidance to predict future financial performance, which means, of course, let me just go back here quickly, which means, of course, predicting everything that shows up on the financial statements. Now, every analyst is going to have his or her own kind of a preference, dare I even say a bias, in approaching these forecasts, which is why the Institute then formalizes this and says something like, hey, let's look, and let me give you just a little preview here. Let's look at some key elements in forecasting. So we'll talk about those things. And then how about some formal approaches to financial forecasting? We'll do 4 of these, and then they'll be top down and bottom up. So I think this is pretty much the most likely exam questions that you'll be faced with. All right, so let's look at key elements here. The drivers of financial statement lines. Well, of course, there are factors that influence every line on the financial statement. The example we have here, number of stores, average net sales per store. I remember back in the old days when I first started becoming aware of Walmart and stock pricing and valuation, that for some amazing number of consecutive quarters, Walmart from quarter to quarter reported an increase in total revenues. And of course, part of that was that it wasn't like everyone was going to Arkansas and buying more more things in Walmart. It was the fact that Walmart was expanding and they were building a store here and they were building a store here. And so average number of stores and that average net sales per store. You see how that kind of refines this element of figuring out what these exact accounts have and their impact on the financial statements. Now, of course, if we have at that top line on the income statement, if we have revenues, we can ask ourselves the question, all right, how do we get those revenues? Well, we have to hire people, right? And we have to do stuff. So we look on the left-hand side of the balance sheet, left-hand side of the income statement, and we ask ourselves the question, all right, which one of these vary with sales? Which one of these don't vary with sales? So that's that whole conversation that we've had and will continue to have about variable costs and fixed costs. All right, how about these individual financial statement lines? These are used for lines without clear drivers, these less material items. Of course, the classic example of this is the amortization expense. Remember, amortization expense is a non-cash expense used to define and account for the loss in value. Do I want to say it that way? Yeah, I guess I will. Loss in value of an intangible asset. We've had lots and lots of good conversations about copyrights and goodwill and all those really, really cool intangible assets. How about summary measures? Of course, we know all about financial ratios. We know all about earnings per share. We know about how important operating cash flow and free cash flow is. I always tell my students that, hey, you know what? The goal of the business, maximize shareholder wealth. You've heard me say that multiple times. How do firms achieve that goal? And there are a bunch of different ways, but one of them is to generate lots and lots of free cash flow. Remember, free cash flow is defined as, here's my definition, but this is a good definition. It's the amount of cash remaining after all expenses have been paid and all investments have been made. So think about that free cash flow. That's really a measure of the quality of all of the other stuff on the financial statements, not to mention the quality of the board and the quality of the executive leadership team and the quality of the workforce. And then there are some extra things out there, these ad hoc objects that maybe are not yet in full swing. Maybe they've been disclosed, maybe they haven't been disclosed. The classic example is a court proceeding. You might go back, I don't know how many years ago it was, 20 years or so ago, Microsoft was being sued by several countries' justice departments for having a monopoly. And so Microsoft had lots and lots of cash on hand. And they had lots of cash on hand because if the verdict was against them, then they were going to have to pay out. If the verdict was in favor of them, then they had all this cash for positive net present value projects. So imagine how that impacts our forecast. Well, the Institute is not going to ask us to be lawyers or legal experts. They're not going to say, hey, predict the outcome of this court case. The Institute might say, though, hey, here's a court case. If the outcome is this, how is that going to impact the financial statements? That's a great question. All right, how about these four approaches? And we probably know a little bit about this from our conversations in quantitative methods. Historical results. Yeah, look at the second arrow point. It's considered the easiest. What we're going to do is say something like, hey, you know what? Our revenues a handful of years ago were 100, then they were 110, then they were 121, then they were 133, and then they were 145. Well, that sounds like a 10% growth rate. Well, if that history can repeat itself, then let's go ahead and predict that based on a 10% growth rate. Now, that was a super easy example, but look at the note, of course, just because we've had exactly 10% growth rate over the last several years doesn't mean we're going to have 10% during this next stage. However, this is really the best way to start. We say, let's look at history and let's go ahead and say, hey, well, based on history, we expect to have something like 10% growth rate next year. So when is this appropriate? Yeah, this is appropriate when there are companies that are operating inside of an industry where there are not any major changes, right? That's what we have applicability there under the green arrow point. That's really a good question. So I can envision the Institute saying, hey, here's a company, just like Jim said, 10% every year. What's the best estimate of next year's growth? choice A would be 10%, and maybe the institute says, hey, this industry is exactly the same. There's nothing changing about it, and then you would say 10% is a good idea. But then they might say something like, hey, it's been 10%, but this industry has this structural change. Maybe it's a legal change, maybe it's an environmental change, maybe it's some other kind of a market-induced structural change, and so then maybe 10% would be a little bit too high or a little bit too low. So just read quickly through the limitations down there. It's not appropriate for cyclicality. It's less appropriate for, maybe just like, hey, let's just do a specific year. It's suitable for multiple years. But what you do then is that you take it to the next step. You use those historical base rates and then you converge it to, and that convergence means you consider all of the current macroeconomic data, all of the current industry data, and all of the current firm-specific data. So, of course, we're going to have to process all of that data. Requires analyst discretion. It's probably way more suited for established industries because we pretty much know how they're going to react when things change. The great example is the 2008 financial crisis. What did we know? We know that after that crisis, during that crisis, right, it was President Bush, and then right after it was President Obama. And you know that these two men were going to say something like, well, we have to prevent this from happening. So we knew there was going to be lots and lots of activity in Washington, and there were going to be more laws and rules and regulations. So the question then is, all right, so in the financial institutions industry, what did we have during the 2000s? Home prices were skyrocketing, banks were writing and creating mortgage-backed securities and all sorts of asset-backed securities. We probably could have predicted that after we have a financial crisis, those products would probably shrink. And some of them did, some of them didn't. And, financial institutions, you guys know this better than I do. Those really smart men and women to try to figure out where's the next profit opportunity. So notice down in applicability, banks, automakers, although I'm going to go ahead and say that the auto industry, now this is my editorialization here, so forget about this for the exam, but the auto industry is really at a point of inflection. Are we going to go down the path of the electric vehicle, or are we not? And so that inflection point is coming sometime soon. So that would be probably a structural change, a dramatic change. And then there would be some intense security analysis and industry analysis to kind of figure out what's the slope of that inflection point. Yeah, limitations not suitable for new or volatile industries or highly cyclical. Yeah, not ideal for industry leaders. That makes a lot of sense. All right, so think about what we've done in these first two approaches. We've taken an historical approach in both of them, and then we've added some current market conditions, right? Current economic conditions. But then there's always going to be something in there that says, you know what? We can look at the financial statements, we can read the Wall Street Journal, we can form our own opinion about electric vehicles, but let's go ahead and ask the executive leadership team. So we need to get out the financial statements, look under whatever it is that the managers are telling us inside of those financial statements. We can read the notes, we can read the guidance, we can read all sorts of things. And from that information, we ought to be able to extract some really good information that will allow us to adjust our targets and make more accurate forecasts, whether it's for revenues at the top of the income statement or net income at the bottom of the income statement or something over on the balance sheet. And this is important in terms of capital expenditures, right? We always ask the question, firms try to find positive net present value projects. Well, we can look on the balance sheet and look at the investment in long-term assets, right? If it was 100 last year and it was 130 this year, well, there's $30 of investing in positive net present value projects. But what you get from this guidance is probably not, hey, all right, so it was 100, then now it's 130. The executives are probably not going to say, well, next year it's going to be 175. But next year, the guidance might be something like, look, we've experienced this 30% growth rate. We're not quite sure sure if we can meet that, but we're looking forward to trying to meet that. And so they'll probably provide us with some kind of a range. And that range can be almost anything on the financial statements. Yeah, why do we use these? Yeah, track record. We can use the management ideas about what is important and what is not important. And I've found this to be true in the academic world. Whenever we try to make some kind of a change, whoever is proposing the change, I'll just go up to this individual or committee or groups of individuals, or maybe the president of the college, and I'll just say, tell me what you're thinking. So that kind of, lasers my thought about what my opinion is about these kinds of changes. So look down at the very bottom of that top box there. This is the advantage of forecasting at the firm level, such as capital expenditures, which is what I was talking about on that previous slide. And then the fourth way, we'll go ahead and say, let's think about everything that we've learned inside of the CFA program. Let's think about everything we learned from our undergraduate days or our master days or reading the Wall Street Journal, and let's combine all of these things here to a discretionary forecast approach. And so it's probably the Institute's intention. It's certainly my conviction that any of us can go back and do this, right? We learned this kind of stuff at the undergraduate level. We learned this kind of stuff, maybe at the undergraduate level, but maybe some graduate work here. Management guidance, anybody can go read the financial statements, right? And you can glean some information. But here, this discretionary forecast is an amalgamation of everything that the Institute provides us and asks us to study and learn so that we can, now remember what I said in that previous recording, we got the macroeconomic analysis, and we had good conversations on industry analysis, and now we're focusing on forecasting. This is part of security analysis. So what we can do is we can use those first three, and then we can add this discretionary forecast approach when appropriate. And there we have some applicability down there at the bottom, which covers the weaknesses of those first three approaches. How do we do this? Surveys, all the quantitative models. We'll do tons of time series stuff in level 2. We'll go back to regression analysis, correlation, coefficients, betas, probability distributions, all sorts of really, really fun stuff. All right, so how do we select a forecast horizon? Whenever you watch a business news show on TV, you guys don't watch TV, whenever you get on your phone and you watch this on your phone, you'll hear an analyst say something like, oh, in 6 months, we think this price ought to be up by 12% to 14%, 6 months. So the question is, how did he or she pick 6 months? Clearly you're not going to have an analyst make a recommendation for 100 years from now. Hey, 100 years from now, I think Amazon will be priced at $42 a share. And someone would just say, boy, that sounds awful low. And you'll say, well, they're going to do lots and lots of stock splits or something like that. So what we need to do is exactly what the Institute is going to teach us through all three levels. This focus, especially in level 3, is on the investment policy statement, where we're going to identify the constraints of a client, whether it's individual or institution, and then we're going to compute a risk objective and a return objective. And we need to link those risk and return objectives. So it's very similar here in selecting a forecast horizon. What is the objective? What is the average holding period of our audience? Now remember, if we're an analyst and we're going on television or on a phone, we're going to have lots and lots of different kinds of people. But if we're an analyst and we're working for a mutual fund and we have specific shareholders out there who are interested in building a swimming pool in their backyard in 5 years, well, then we have a 5-year window. So think about what that average holding period might mean, and look at the bottom bullet point there. We'll probably focus. Of course, we want to give some kind of a short-term idea, but then we want to focus on the long term. 3 to 5 years, maybe less than a year for the short term. And my students are seeing this when they go to the Morningstar software that's in our finance trading lab. And we see historical returns and historical net asset values, let's say, for short time periods and for longer time periods. So that applies here. We also need to worry about some other factors here. Cyclicality, that makes perfect sense. Company-specific factors. In particular, company-specific factors that are dramatic events that might play a pivotal role. Think of all these gigantic mergers that have been going on and that continue to go on. And then maybe the analyst has an employer who says something like, most of our clients are long-term. They're interested in estate planning. And so we're going to use their capital to maximize the value of their estate so that they transfer ownership of all their assets to their children or grandchildren or to this institution over here. We want this to be super long term. So we might have clients who are interested in a 10-year window. Let's focus on those long-term effects. So what happens then in the longer the term is that the shorter term evaluation and the shorter term elements become less important. The firm-specific elements become less important, and then the overall macroeconomy becomes way more important. We'll learn this in a subsequent equity conversation when we learn about beta and systematic risk and all sorts of fun things like that. Now, we did the 4 earlier approaches. Here are 2 additional approaches that can be performed in the context of those 4, but they can be performed on their own and then bring elements of those other 4 approaches. And I say this regularly. The Institute is super interested in top-down approach and bottom-up approach, so they call them drivers here inside of this learning module. So top-down forecast drivers, growth relative to GDP growth. So this is what I was saying in earlier learning modules. We start with a macroeconomy. So we got this big ball here, and each industry has its own part of the ball. And then each firm has its own point inside of that ball. So you have GDP growth, then you have an industry growth rate, and then you have an individual growth rate. And so let's do growth rate relative to GDP, market growth rates, and market share. Those are all top-down forecast drivers. And by the way, there's a really good exam question, end of learning module question here that asks you to identify top-down or bottom-up. And I think growth and market growth or market share, they're in there. How about bottom up? So we're starting at the base level and then work our way up. So individual forecasts of volume and prices of the company's products. So that's just P times Q. So you start with the revenues at the top of the balance sheet of the income statement, and then you can look at product lines, you can look at capacity-based measures, or you can look at return measures based on account balances or revenue yields. So that return or yield-based measures, those would be some of the ratios that we've talked about in previous learning modules. Now, as we go through the historical evaluation of a company's financial statements, somewhere on there's going to be a line that says something like, oh, by the way, we sold our segment last year for $20 million or whatever that is. So this is a non-recurring item. So that $20 million, that shows up in cash. And it looks like we have lots and lots of cash, but we sold an asset to do it. So we need to make sure that we separate the non-recurring items from those items that are sustainable and repeatable that are going to generate, what I always refer to as sustainable operating cash flows. Now, some of these non-recurring items will be disclosed. Some of them will not be disclosed. So make sure that you can distinguish between those two. A lot of times, the disclosed non-recurring items will include international transactions for global firms. But there are non-disclosed, non-recurring items that can't be quantified, or at least are not quantified by management. So what we're going to have to do is try to figure that out. And the way to figure that out is through scenario analysis. And we'll do that in just a little bit. All right, so we did talk a little bit about the revenues. Let's go ahead and talk a little bit about the left-hand side of the income statement. We'll just call these cost of sales. What does that mean? These are variable costs, so they are directly linked to sales. So if we have an historical cost of sales to revenue ratio of 70%, well, then that's probably what it's going to be going forward. And so that makes a lot of sense. What we can do is do some sensitivity analysis or elasticities here and say something like, hey, suppose that revenues go up by a little bit, whether it's a P times a Q, whatever that is, what impact is that going to have on, let's say, gross profit or gross margin? What impact is that going to have on cost of sales? If it's been 70% over the last 10 years, why can't we make it 68%, right? Why can't we improve our efficiency? Maybe we can improve our efficiency through things like hedging. Now, we'll talk at length about hedging when we get to derivative contracts, but if we're a company like General Mills and we make cereal and breakfast bars and all that kind of stuff, what are our inputs? What do we put in cereal? There's corn and wheat and sugar and oats and milk and whatever else goes in there. But those are commodities. What do we know about commodity prices? They go up and they go down. So we'll probably want to try to hedge either directly through a derivative contract or indirectly through some other kind of a method that we'll talk about some other day. There's a good word down there, the product demands price elasticity. How about looking at the competitors' gross margins? That makes sense. SG&A, from my perspective, these are really not too terribly interesting. These pretty much don't have that high correlation with changes in revenues. Although we can go ahead and measure them as a percent of sales, but what we're going to do is probably just say something like, let's look at these SGAs, what they've been over the last several years, and then let's go ahead and figure out, well, what's inflation in selling, what's inflation in general, what's inflation in administrative. So, something in there has to have some kind of wage increase. Working capital, this is super important. I teach working capital inside of my capital budgeting conversations where I say something like, all right, we're going to invest in this positive net present value project. What impact is it going to have on things like inventory, accounts receivable, and accounts payable? So what we're going to do is measure this working capital, right? Difference between current assets and current liabilities. We can use tons of those ratios. We'll call them efficiency ratios from prior conversations. Now, here's my favorite part of this entire learning module, capital investments and capital structure. I'm a big capital structure guy. We'll talk about Modigliani and Miller going forward, but this is capital investment is capital budgeting. What projects are we going to invest in? What assets are we going to buy? What product lines are we going to select? Which product lines are we going to reject? So these are the positive net present value projects that's emphasized throughout the CFA program. The question then becomes, how do we pay for it? If a company like Nike comes along and says, what does Nike do? They make lots of stuff that we wear. Well, maybe Nike wants to do something a little bit out of the box, whatever that might be. Maybe they want to make tires for cars. Maybe they want to make, because they have rubber, right? Aren't there rubbers go in the bottom of the sneakers? Maybe they want to make mirrors. Maybe they want to do something else. Maybe they want to make sunglasses. Whatever it is, it's going to cost a lot of money. How do they pay for it? Do they issue a bond? Do they issue shares of stock? All right, so this is capital investments and capital structure. What are we investing in and how are we paying for it? So then, what kind of asset is it? Are we going to have depreciation? Are we going to have amortization? And what impact is that going to have on the cash flow statement? Do we pay interest to the bondholders? Do we pay dividends to the shareholders? Now, I think this is the great exam question. Look at that third arrow point, 2 categories. Maintenance of capital expenditures. What this simply means is that, Nike has all these machines, to make clothes and sneakers. Well, they wear out. So sooner or later, we're going to have to update the software. We're going to have to replace a moving part. We're going to have to do something. maintenance capital expenditures. So these things tend to be relatively small. Growth capital expenditures, this is what I was talking about moving into the sunglasses product line or the tire product line. These are huge capital investments needed to expand. So in order to evaluate the capital expenditures, whether they're maintenance or growth, we need to look on the balance sheet, right? And pay careful attention to depreciation expense and accumulated depreciation and all those kinds of things. But then when we ask ourselves the question, are we paying for it with a bond issue? Well, then we need to go and calculate leverage ratios, right? Are we increasing leverage? That means we're increasing financial risk. Why do we use leverage? To magnify returns. So this is a good thing if the product line is successful, but it's not a good thing if the product line is not successful, because this then brings in the specter of bankruptcy. So how do we project future capital structures? Of course, we look at industry capital structures. We look at historical capital structures. We go read the management notes and we say something like, oh, there's a line in here where one of the managers said, we think we have too much debt. So that means that we're going to have a reduction in long-term bonds going forward. Now, here's a fun thing. This scenario analysis, I said something like we're going to take all of these inputs and we're going to change them, or we're going to change them on a global level, right? So look in the very middle. Changes in the business cycle, changes in competition, changes in inflation, changes in deflation, changes in technological developments. All of these changes are going to result in different forecasts. So I always tell my students to think of it like this. This is the easiest way to think of scenario analysis. Whatever you're trying to forecast, whether it's revenues, whether it's income, whether it's capital structure, go ahead and think of scenario analysis as the following. 3 possible outcomes. Best case scenario and the worst case scenario, and then the most likely scenario, right? Whatever that means, best case revenues, worst case revenues, most likely revenues. But then with scenario analysis, you can slice in between, hundreds of times if you want to, depending on how granular that you want to have your analysis be. All right, so the question then becomes, when are we going to use this scenario analysis? And I like that first diamond point there. When industry risks and business risks can lead those future outcomes to deviate from not only our forecasts, but from other forecasts and other expectations. So that's probably a really good exam question. And that takes us through this forecasting learning module. So I want you to go, as I always do, go to the end of this learning module. There are 8 questions. You'll need your calculator for the 8th one when you're asked to forecast a particular variable. But the other one should be relatively straightforward. Hey, thanks for watching. Have a great day and good luck studying.